ICF International just dropped their third quarter numbers, and wow, the market's reaction was fast and it was not pretty. So, in this breakdown, we're going to dig into exactly what happened, look at the results, see what management is saying, and figure out what it all means for the stock from here. All right, here's our game plan. We'll kick things off with the market's reaction and those headline numbers. Then we'll get into the two very different stories happening inside the business. After that, we'll cover what management's outlook is, and we'll wrap it all up with our rating and what to watch for next. Let's get to it. So, how did Wall Street handle this report? Well, let's just say the verdict came in quick, and it was pretty clear. Ouch! The stock just plunged, dropping over 6% right after the earnings came out. And this wasn't just some minor blip. The trading volume was huge, about 2.5 times the daily average. That tells you there was some real conviction behind that sell-off. And this slide right here, this is exactly why the market freaked out. It was a miss on both the top and the bottom lines. They fell short on earnings per share, and revenue came in way lighter than anyone was expecting. But the real kicker? That revenue figure is down a full 10% from this time last year. That's the kind of number that gets attention, and not in a good way. So you have to ask, what drove that big miss? Well, the answer is actually pretty simple. It all comes down to their government contracting business. And the numbers here are just stark. Revenue from their federal government clients absolutely collapsed, down nearly 30% compared to last year. This is the single biggest weight dragging the whole company down right now. And it's not just one single issue either. It's more like a perfect storm of problems all hitting at once. You've got funding cuts, the government is just taking forever to award new contracts, and all of that was made even worse by project delays from the government shutdown. And management actually put a price tag on that shutdown. They figure it's costing them about $8 million in revenue and around $2.5 million in gross profit for every single month it continues to drag on. That's a serious headwind. But, and this is a huge but, the federal business is only half the story. While that part of the company is really struggling, there is a completely different, much brighter narrative playing out on the commercial side. And it's all part of a very deliberate strategic move. I mean, the contrast here is just night and day. While federal was getting crushed, the commercial energy division saw its revenue surge by 24%. This growth is being fueled by utilities spending a ton of money on things like energy efficiency, making the power grid stronger, and electrification. And you can see the result of that pivot right here. The whole business mix has changed. This non-federal work, which, by the way, comes with better profit margins, now makes up 57% of all their revenue. Just a year ago, that number was down at 46%. That is a massive shift in a very short amount of time. Now, this is a really key number if you want to know where things are headed. It's the book-to-bill ratio. All it means is that anything over 1 shows the company's booking new business faster than it's finishing old projects. So at 1.53, that's a very healthy sign that the demand engine is still humming along nicely. Okay, honestly, this might be the single most impressive part of the entire quarter. Think about it for a second. Revenue is down 10%. But their margins actually went up. Both gross margin and EBITDA margin improved. That's incredible, and it proves that their shift to this higher margin commercial work, plus their tight cost controls, are absolutely working.
So you've got this massive federal drag being offset by this really strong commercial momentum. How is management planning to navigate such a complicated situation?
Well, their game plan seems pretty clear and focused. Priority number 1, protect the bottom line. Keep costs in check, and keep pushing that favorable business mix. Priority 2, just weather the storm of the shutdown, making sure you keep your best people so you can ramp back up fast. And priority 3, pour fuel on the fire in the areas that are growing like crazy. And the CEO, John Watson, he was really direct on the earnings call. He basically said over and over that they are confident this is a temporary problem and that the company is on track to get back to growth in 2026. He keeps pointing to their massive pipeline of contracts as the evidence. As for their official guidance, they're mostly sticking to their full-year plan. They still expect revenue to be down no more than 10%, even with the shutdown. The one little trim they did make was to their operating cash flow forecast, which makes sense, right? It just reflects that it might take longer to get paid by the government. All right, let's put all the pieces together. We've seen the numbers, we understand the push and pull inside the business, so now let's make a call on what to expect from here. The story for ICF right now is a classic tale of two businesses. The bear case is all about that federal segment, the ugly revenue decline, and the shutdown problem. But the bull case is all about everything else, that fantastic commercial growth, the strong demand signals, those expanding margins, and a successful pivot in strategy. So the multi-million-dollar question is, which one of these stories is going to win out over the next quarter and beyond? Our take is that the fourth quarter is probably going to be another tough one. The government shutdown will be a factor for the entire period, so we're expecting to see year-over-year declines that look a lot like Q3. The real growth story that management is talking about, that feels firmly like a 2026 event. And because of that, we expect the stock to pretty much be stuck in a holding pattern. The commercial strength provides a nice floor under the stock, but all that federal uncertainty creates a ceiling. The market really needs to see a light at the end of the tunnel with the shutdown before this stock can make a big move up. So with all these dueling forces at play, we're giving this a market perform rating. It feels like the bad news from the federal side is already priced in after that big drop, but the real catalysts that could send the stock soaring, well, those seem to be on the 2026 horizon, not the immediate one. This is not financial advice.